Now to our overtime exclusive. DoubleLine Capital's Jeffrey Gundlach is with us live to react to what the Fed just said and what the Fed just did. Jeffrey, welcome back. It's great to have you on the new program.
Yeah, nice to be on your new show, Scott. Congratulations.
Thanks so much. So you heard the Fed. They've spoken. It's your turn. What do you think?
Well, the Fed follows the two-year Treasury, and I've been saying this for years and years. I don't know if your viewers can see this chart here, but it's a chart of the Fed funds rate in red and the two-year Treasury in blue. And so look what the two-year Treasury in blue did starting fourth quarter of last year. It went up by, guess what, 175 basis points. So what did the Fed do today? They said they're going to raise Fed funds by 175 basis points. And so that's just them following again. And they're way behind. I was listening to this prior segment. You know, here's one more chart I'm going to give you. The blue line is wage growth, wages and salaries, and the employment cost index. The red line is Fed funds, the blue line is the wage growth. If you look carefully at that chart, the Fed follows wage growth historically. That chart goes back to 1985. This time, wage growth has exploded higher and the Fed has been behind the curve. And I thought that Jay Powell did an okay job today. He was a little bit of an equivocator. I thought it was better than the last time we were in this sort of a predicament, which was in the fourth quarter of 2018, when the Fed was raising rates and doing quantitative tightening. I think the stock market was way oversold. I think commodities got way overbought. And so I'm not surprised that we've had relative market stability into this Fed decision. And I expect that the oversold will continue to work its way higher. In other words, stocks will go higher. I saw your question about will we be higher on the S&P at the next meeting. I think probably we will be over that time period. The stock market was very happy. I think we will be happy higher because we're oversold. And we didn't get the 50, which the market was fearing, I think, although I thought the probability of that was awfully low. And we didn't get any clarity on reducing the balance sheet. And I think that the market kind of likes the fact that the party's going on. They sort of like the fact that the Fed is behind the curve for now, even though it means that they may have to accelerate and get in front of the curve. For now, rates are still really accommodative, and the Fed didn't do the 50, and they're not shrinking the balance sheet yet. I think the market will roll over once the Fed raises rates a couple more times, and if they start the roll-off, which he sort of alluded to being the base case at the next meeting, I think that's when you've got the double whammy. At least he didn't pull the 2018 thing of autopilot. He tried to have some flexibility. He gave the impression of autopilot, but he didn't say it, and I think he even said the word flexible or nimble or something like that. And so the market likes that over this oversold.
So the median Fed official now sees 7 hikes this year, right? So 6 more for the remainder of the year. Does that sound right to you? Is it too aggressive? Not aggressive enough? Too late? We know it's too late. But how do you see where the Fed sees things today in terms of the number of rate hikes that we now expect? When we visited about a month ago at the Super Bowl, you said probably 5 or so was the number. This appears to be more aggressive. And make no mistake, this was a hawkish Fed today.
It was definitely on the hawkish side. He tried to thread the needle, but it was too hard to do. So it was a little bit hawkish. I'm just going to say it one more time, Judge. The Fed follows the two-year Treasury. Two-year Treasury went up 175 basis points. Now they're talking 7 hikes. The two-year Treasury has gone a lot higher in yield since we met on February 11th. And so it's totally appropriate for the Fed to be adjusting that higher. But the one thing, I heard a lot of discussion about financials, and it relates to where we are in the cycle. I think Josh Brown really nailed it. And that is, we're starting this Fed hike cycle with a very flat yield curve. Typically, when people say financials are good for the first 3 or 4 rate hikes, that's because the curve starts out steeper than where we are right now. The curve, 2s to 10s, is basically puts you on recession watch when it's inside of 50 basis points, and it gets you on a really big recession watch when you get down to flat. We're right exactly in the middle at 25 basis points. And that is an incredibly flat yield curve given where we are in terms of the absolute rate level versus the inflation rate and the whole thing. Also, investors should look at 5s, 30s, the yield spread between the 5-year Treasury and the 30-year Treasury. Same deal. You're on recession watch when you're inside of 50, and when it inverts, you're pretty much on your way to recession. Well, same thing as 2s, 10s. We're right there in the middle. But the big message of the market today that people haven't really talked about is that the 30-year Treasury bond rallied. The 30-year Treasury bond 1 year ago was basically at exactly the same level as it is today. The attitude about Fed policy has changed so mightily in the last year, and the 30-year Treasury rate is unchanged. Interest rates in Europe have gone up on 10-year Treasuries by a fair amount from a year ago. They've also gone up in Japan, but not the United States. All we've done is flatten the curve. And that puts us later in the cycle, I think, because as people have said correctly, the bond market has done the tightening. They're following the 2-year. And the flatness of the yield curve at these rate levels is something that is going to be problematic. But again, the market is working off an oversold. When the VIX gets towards 40, I've just gotten to the point in my career where I've seen this movie so many times. When the VIX gets above 35, I don't care how bad the tape looks. I don't care how bad the geopolitics look. You're supposed to get more bullish, not more bearish. And you get an oversold bounce. And the market was very oversold, particularly the NASDAQ, and commodities were very overbought. One thing on the inflation. Inflation has surprised everybody to the upside just about, and it's going to remain sticky, but you are going to get some relaxation on inflation. You're going to have these base effects. It's a true narrative that you have huge month-over-month increases that are coming in several months from now, and it's likely that we're going to see the year-over-year inflation rate go down somewhat. So that might give the Fed a little bit of a tailwind and not have to work so hard. But Jay Powell said powerful tools, using our tools, we're going to use our tools, we're going to bring the inflation rate down. So you're right to coin that, to frame that as a hawkish meeting.
Yeah, 10% inflation is what you recently said you thought the projection would be. Are you sticking with that today, or was that a little bit hyperbolic?
It was a little hyperbolic. I actually said, I think 9 and maybe 10. I'm not sure we're going to get a 9 now because the commodity prices have come down a fair amount. That was at the moment that oil was at about $125 a barrel. And the decline from there has been sufficient that it looks like we're going to get 8-handle inflation. We might even get it, in the next print, and it might stay there for a couple of months. But I don't think we're going to have the same inflation rate for the full year 2022. I think it's going to be lower for the full year than it was in 2021, but not what the Fed is forecasting. We're not going to get low 4s. We're not going to get mid 4s. I think we're going to be talking about, again, it's going to have a lot to do with the commodity complex, but I think we're going to be talking about something around high 5s inflation for 2022, which is still not close to the Fed's stated target, all the way down at 2%. So one thing I want to talk about is there's a way to project what the yield curve will look like in a year using, well, the 1-year forward curve of the Treasury market. It's pretty wonky, but it predicts 1 year from now that the 2-year Treasury will be at 250 and every other rate along the yield curve will be at 250. Now, I respect the bond market message, of course, but I think that's too high. I think actually the yield curve will be flat, but it won't even be as high as 250. So we've already seen, I think, the peak potentially in the 30-year Treasury bond because it just doesn't go up in yield in spite of all of the changes we've seen macroeconomically and with the Fed. We're just getting a flatter and flatter curve. So the strange thing is that this year to date, we've had highly correlated S&P 500 stocks and Treasury market and the bond market broadly. Unfortunately, it's correlated on the downside. So stocks down, 10, 12%. Through yesterday, some down much more than that. But, just a bond market index is down, 5%. So the 60-40 mix that people traditionally have, and I think they've probably wandered from that in recent years, but that 60-40 mix is a pretty lousy return for the first quarter. It might get a little bit better in the final 2 weeks. But I think what Josh Brown said again, I thought he made some good points. I think he said that when people get their statement, they're not going to be happy. And that could lead to the next, some volatility as we enter the month of April.
Let me ask you this: Do you think we're going to have a recession? And are you more or less confident today that the Fed can actually pull this off, in part because of what you said about inflation actually coming down a bit, not to target, clearly, but certainly not going the opposite direction any steeper?
It's a really bad bet to count on the Fed engineering a soft landing in this kind of environment with the curve partially inverted, but let's just call it quite flat at this low yield level. I just don't see it. And again, I can't reiterate enough, this balance sheet tapering or shrinkage is going to be correlated with a significant headwind for the S&P 500. I've talked about this for years, that there's a tremendous correlation between the size of the Fed's balance sheet, which is now just under $9 trillion, and the market capitalization of the S&P 500. And we talked about how that was going to be supportive back last summer. That was going to be supportive into year end. But now we're going the other way. We've got the Fed raising interest rates, and it's the great Marty Zweig used to say, rule number one, don't fight the Fed. Rule number two, see rule number one. And the Fed is raising rates sequentially as a base case, and they're going to be tapering. And that means multiple contraction is going to continue. And this is going to be, I don't think we're going to go back to the highs of the year in the stock market. I think we're going to be higher in May, but I think we've seen the high of the year with the Fed and the yield curve and the consumer sentiment being pretty soft. Although I will say something on the consumer sentiment. I noticed that somebody commented that it was in a free fall, and that's true, from the University of Michigan. But it's really because of autos and housing. And autos are up so much that people realize that it's a very uneconomic time to buy a vehicle. And housing is up 30% on the national median over the last 2 years. It's just possible that the sentiment will get a little bit better if the inflation numbers start to peak out. And if we can just get that inflation rate below 6, it's possible that the recession gets forestalled. I don't have a base case of a recession this year, but I do think that we'll probably get one in 2023.
Okay. Now, Jay Powell talked about that, too. Doesn't see it this year either. Not that he's going to come out and say it today for certain, but you get my point. Jeffrey, sit tight. We'll take a quick break. I'll come back with Jeffrey Gundlach, get more opportunities on where to put your money. Don't go anywhere. Overtime is back in just 2 minutes. Welcome back to Overtime. More of my exclusive conversation with DoubleLine CEO Jeffrey Gundlach. We've had a lot of big hitters on the network this week. Jeffrey, Scott Wapner among them, who said, and we've talked a lot today about the 2-year, and you mentioned the 30-year, but the 10-year, he thought maybe the yield was topping out, in his words. 2 to 2.25 was the range he saw. You agree with that?
I think the long end, as I referenced in the first segment, I think the long end it saw its peak last year. I mean, the long bond was up substantially higher than at its peak, where it is right now. And so I think broadly that the long end of the curve is reasonably safe place to be, which is a very strange thing for me to say, because the valuation of it is so terrible relative to inflation. You have a long bond, below 2.5%, you got the inflation rate pushing 8%. But basically it's because of the economic situation and the uncertainty and the relative comparison to other bonds in the world, even though that comparison has gotten less favorable for the United States. But I do think that investors, and we've been talking about this in our get-togethers, Scott, for the past few times. That as weird as it sounds, I think investors should own long-term treasuries as part of their portfolio. Certainly, if the inflation rate is rated lower as we move forward in the year. So I think those are okay. In fact, I think bonds broadly are sort of okay, in spite of their bad valuation. In fact, one area that have not been very enthusiastic about for quite some time is the corporate bond market. The investment-grade corporate bond market, the yields have quietly been going up and going up faster than Treasury yields, which means their relative spreads are getting wider. And the balance sheets of corporate America are in great shape. The other thing that now has turned into a potential positive with corporate bonds and longer-term treasuries is that duration, interest rate risk isn't a problem at the present time. So corporate balance sheets are in good shape. Corporate bonds have they have a lot of interest rate risk, which hasn't been good, but now it's not being that painful. They have a duration. The LQD ETF at times has a duration of 10, which means it has more interest rate risk than even the 10-year treasury. but they've gotten cheaper, and credit product broadly has gotten cheaper, even as yields have gone up. So until such time as there's closer to a recession in view, I think it's a reasonable time to be moving into some of these areas that have been widening kind of stealthily in the last several months. So
now, this is very interesting.
Yes, go ahead.
I'm sorry. Finish your thought. My bad. I didn't mean to step on your toes.
Well, that's all. That's fine. I'm just saying that we've been actually buying some corporate debt, and we had liked bank loans in the junk bond market relative to regular high yield, but our attitude on that has really neutralized, and now we're sort of favoring regular high yield more. I think that the investment business is always anticipatory. So everybody knew that the Fed was going to go on a sequential rate hike thing. And so the fact that that was going to happen got priced in the bank loan market. So BKLN, the bank loan ETF, held up until very recently far better than JNK, which is the ETF for junk bonds or high yield, so-called high yield bonds. I call them junk bonds because their yields aren't high. But but I think what's been happening in recent weeks is people are starting to realize that the Fed is priced into the market. The two-year Treasury is priced in all these rate hikes, and the bond market is saying that we're not going to get that much more of a yield increase on the two-year Treasury. It'll go higher, of course, but I think the two-year Treasury even could be getting close to its peak for this cycle. The bond market says it's going to peak out around 250. As I said in the prior segment, I don't even think it's going that high. So at 2%, which we kissed today on the two-year, what's wrong with the two-year Treasury? I mean, it's very low risk. It matures in 2 years. It's probably a good time to have dry powder sometime in the next 2 years if you're going into a recession. But just shorter duration product in general that has very little interest rate risk. And I've been talking in the past with you, Scott, of having cash. And these days, I think you're better off in the two-year Treasury than you are in cash, because it's going to take time for cash to get your yield up to that 2% level where the two-year is. So a barbell in the bond market is sort of interesting, where you own sort of the short end and the long end, because there is really no yield difference. You own them for totally different reasons, but both of them have a spot in a portfolio.
I love the fact that you're giving our viewers in overtime some real actionable advice. But I have to say, in listening to you talk for the past several minutes, I don't know what was in your breakfast this morning. You're more positive on a lot of things than I expected you, frankly, to be. You think stocks can go up until May. You're suggesting that bonds can be a good investment, so bonds and stocks can go up at the same time. You talk fairly favorably about high yield in certain opportunities, and you even think inflation is going to come down, even, albeit slightly. That's a much more positive, if you want to call it that, picture than, frankly, Jeffrey, I expected from you.
Well, Judge, I'm old school. When you mark down the NASDAQ 20%, I like it better. I don't like buying stuff what's an all-time high and a massively stretched valuation. I didn't like junk bonds at all, several months ago. I didn't like corporate bonds because their spreads were too tight. But when the market reprices, you've got to reallocate your thinking, your portfolio. So on a really big picture thing, I want to show the viewers two more charts. The one I've been talking about, European stocks versus U.S. And here's the chart. When the blue line is going up, that's the S&P 500 outperforming Europe. And when the blue line stops going up, which happened back in 2020, almost 2 years ago, Europe has performed in line, even lately, which is sort of shocking given how much exposure Europe has to this war that's going on between Ukraine and Russia. And yet, yeah, they underperformed briefly when the invasion started, but they've basically snapped back and have been in line with U.S. stocks. So I kind of still think that you have a reason to be longer-term allocating. And one last slide, which is the NASDAQ versus the S&P 500. When the blue line is going up, the NASDAQ is outperforming. This was the .com thing. This is now, and we've rolled over. So I think that the NASDAQ is not the place to be. For the short term, yes, because it's oversold. But if you're truly an investor, I'm not talking about between now and May here. I'm talking about looking forward to 2023 and beyond. I think you want to avoid these greatly overvalued momentum stocks. And I also think that the investors should potentially think about investing in emerging market equity gradualistically. It's volatile as all get out, but
Well,
I think ultimately it's going to be a strong performer for a multi-year horizon, and it's cheap.
So you said at the Super Bowl when I talked to you about emerging markets that, and I think you said it almost exactly, you didn't start buying it yet. It's okay to start, averaging into it. Have you started doing that yourself in emerging markets?
No, I have not. I've not bought emerging market equity. I really, one of the reasons is that for the emerging market trade to really work, you need the dollar to go down. And the dollar is on a flight to quality bid, and it's also bid up because the yield curve flattening is one of the best short-term indicators of the direction of the dollar. So the yield curve flattening leads to a higher dollar, and the yield curve steepening tends to lead to a weaker dollar. So with the yield curve flattening, the dollar has maintained a bid, and with the geopolitics. So the trade I'm talking about with emerging markets is one you want to invest for your grandchildren's college education. It's one where you want to buy it systematically. I'm not in any hurry to start doing it, but I don't think it's foolish to start doing it. I'm just being more, I watch this stuff like a hawk day in and day out. Mm-hmm. For somebody that has a real job, they might want to put in something systematic. You can't watch it tick by tick. But I will observe that emerging markets have also stopped underperforming. In spite of all of this upheaval. Also, emerging market debt, ex-Russia, has widened out a fair amount stealthily as well. It's about 450 basis points over treasuries, and that's widened by a fair amount. So emerging market debt is something we've been cautious on, and thankfully, for various reasons, we were extraordinarily underweight in Ukraine, Russia, and the like. So we've managed to sidestep that banana peel. But I do think that a lot of these things that have widened out, I'm expecting some stability. As a trader, you want to be increasing risk. As an investor, and I mean 2+ year horizon, you actually want to use this period of strength to reduce risk.
Okay, let me ask you finally before I let you run. Bitcoin or gold in this new environment that we're now in? We at least have a little more certainty on where the Fed path looks to be. What would I rather own today if I'm watching this program, Bitcoin or gold or crypto? Or you could take crypto in general or gold.
Bitcoin has fallen into a range with the high end being 60,000 and the low end being 40,000. And it seems like every time we get together, it's either at 60 or at 40. Last time it was at 40, so it hasn't moved since then. The time before that it was at 60. So with the range of 40 to 60 and gold being in a range that's sort of, I don't know, let's call it 1750 to 2000. Gold is sort of in the middle of its range. Bitcoin is at the low end of its range. So I would take, or now through the next Fed meeting, I will take Bitcoin over gold.
Ah, interesting. Okay.
Yeah, look,
I appreciate.
You can't believe all this positive stuff I'm saying.
Yeah, exactly.
It's for the short term. Again, my long-term view is still that we're in a debt disaster situation. And the only way out is to monetize or to default. That's always going to be the case. The mathematics just doesn't work of paying off $168 trillion of unfunded liabilities with a $24 trillion nominal GDP. That's still coming, and it's coming in the next recession, unfortunately. That's when the dollar goes down. So that's what I'm telling investors.
You gave us and our viewers a lot. That's for certain. Put the next Fed meeting down on your calendar. We want to have you back in overtime to digest and discuss that one, too. Jeffrey Gundlach, I appreciate your time today. Thanks so much.
All right. Thanks, Judge. Good luck, everybody.
All right. We'll see you soon. Up